Brian, great to see you. Thanks so much for joining us.
Wilf, good to see you, and Happy New Year. I haven't seen you since the New Year, and Happy New Year to Sarah also.
Well, very Happy New Year to you, and great to get you to get your outlook for the year ahead. But before we get to the outlook, maybe let's just touch on that fourth quarter that's in the books. And I guess we got a glimpse of what you've been talking about for a long time, that when rates do rise, you see the net interest income and the revenues pick up. Costs went up too, but importantly, less than revenues.
Well, I think we'll just back up big picture. Revenues year over year up 10%, costs up 6%. A lot of that cost related to the markets-related businesses, whether it's wealth management or capital markets and investment banking and trading, that draw compensation based on that. But rates have not risen yet. I mean, our driver of rate increases and NII coming from that is not come through yet. That's ahead of us, largely because we're so sensitive on the short rate side, not to get overly technical. So the fourth quarter, really, rates moved up a little bit along bond, but the real value that comes is the Fed raises the short-term rate, because when you have $2 trillion of deposits and $1 trillion plus of consumer deposits, $1.4 trillion of deposits with American consumers more broadly out of our retail segment and our wealth management segment, those stay at zero because they're non-interest bearing, $600-700 billion of transactional accounts. So we'll get a lot of leverage, but we made $1 billion in NII first quarter, fourth quarter this year without any major rate changes. In fact, they came down a bit.
And if we do get that environment that'll benefit your top line in the year ahead and rates go up, would you expect costs in the year ahead to go up by the same magnitude or significantly less? As you know, this quarter, there's been a huge focus from investors across all the banks on cost forecasts for the year ahead.
Well, we've got a decade-plus history of managing the costs in this company well. We do it by constantly investing in improvements of what we do. And so we told our shareholders today that expect costs to be relatively flat for 2022 versus 2021. And, we're confident we can do that like we've been. We continue to take money from the operational process. You can automate. Our customers' behavior automates across all our businesses. And we take that money, invest it back into growth and expansion, whether it's new branches, whether it's $3 billion plus of incremental code development every year, or whether it's more relationship manager help draw that $50 billion in loan growth in the fourth quarter. We invest heavily in a franchise. This year we can do it. This year, 2022, was relatively flat cost of 2021, and we're confident we can do that.
Let's touch, Brian, if we can, on that loan growth. It stood out relative to peers. I guess the question on everyone's lips is, can it continue in the year ahead? And if there's any factors you're looking out for that could derail it, including, of course, raising rates.
Well, I think if the reason why rates are going up is the economy is going to grow at 4%, which is our team's prediction this year, that's good for loan growth. Think about before the pandemic, we had got nearly $1 trillion of loans on the books. And the commercial customers grew at the lines of credit at 35% just on average. That dropped to 25%. That's like $40 billion of loans. Now, we've gotten about half of that back, and that's coming through. And then the new loans we're doing in the consumer sides. And we're still $20 billion off of what we had in credit cards heading into the pandemic. So there's lots of room for growth on the loan side. In the fourth quarter specifically, $50 billion of loan growth, about $15 billion in markets, which can ebb and flow with securitization and some of the work that goes on in that. And Jimmy DeMar and the team do a great job there. But $35 billion was in the core businesses. In the first 3 weeks of January, that's grown from there. So we feel good about loan growth, largely due to the fact that we have this incredible franchise, which has cranked back up after the pandemic got more manageable.